Unit 6, Bonds, Lecture 6, Yields and Quotes. We're going to look now at yields and how bonds are quoted. Now, we're looking at some traditional bond yields. We've been introduced to the yield to maturity. We know that this measures the return on the bond if it is held to maturity and all coupons are reinvested at the yield to maturity. We look now at the current yield. Now, this is a yield that gives us an indication of the income. So it is calculated as the annual coupon over the current bond price, and it is used to compare the income provided by a bond relative to other assets. There's the nominal yield, which is a percentage of the interest paid on the bond periodically, and that is calculated as the coupon over the par value. The yield to call is the yield on a callable bond. That is a bond that can be repaid or called by the issuer before maturity. And we would calculate it in much the same way as we calculate the yield to maturity, except it would be the term would end when the bond is called. And then there's a realized or holding period yield. This is the yield on the bond that an investor sells prior to maturity in the secondary market. We're now going to look at how bond prices are quoted. So a bond price can be quoted on either a yield basis or a price basis. Here in South Africa we use yield quotes, and they are always interpreted as 100 minus the yield to maturity. In the United States, prices are price quoted, as they are always interpreted as a percentage of par. We're looking here at an example of a price quote. Price quotes are always interpreted as a percentage of par. If you look at a price quote of 98.5, this is not $98.50, but 98.5% of par. So for example, if the par value is $5,000 on a municipal bond, the price of an issue quoted at 98.5% would be $4,925. This is an example of a yield quote. Yield quotes give quotes in terms of yield to maturity. If a yield quote is given, that's the interest you will earn from buying the bond now and holding it to maturity. Yield to maturity is an annualized internal rate of return. For example, if the par value is 5,000 Rand on a municipal bond, then the price of an issue quoted at a yield of 7.25% would be 100 minus 7.25, which is 92.75. Therefore, the price would be roughly 92.75% of par. Now here we're looking at an example on how to interpret bond quotes. So this is a bond that has been issued by the Ford Motor Company with a coupon of 7.45%. Its maturity is July the 16th, 2031. If we look at the extract we have at the top, if you look at the last transaction price, this was 80.625% of par. So for a par value of $1,000, this works out to $806.25. And if you look at the last yield column, this implies a yield to maturity of 9.461%. Now the computed yield spread is 503 basis points, or 5.03%, when compared to the prevailing yield for a US Treasury issue with a maturity of 30 years. In this example, we're looking at price quotes. So we have a 3% Treasury note, which is due in February 2009. The bid quote is 114, implying a bid price equal to 100.4375% of par, because the 14 is 14 over 32. The same applies to the ask quote, and if one buys at the ask price, the yield to maturity will be 2.22%. We're going to move now onto the global bond market. We're going to start by looking at who issues or who the issuers are on this market. So we're going to have sovereigns, these are governments, quasi-government agencies and foreign governments, these are government-sponsored enterprises and federal agencies, securitized, corporations, high-yield and emerging market. Securitized bonds are bonds backed by cash flow securities such as mortgages or car loans, and the high-yield or emerging market are high-risk instruments. Now, all bonds that are issued, whether they're issued locally or globally, have to be rated. There are credit rating agencies that rate these issues, and they depend on a number of factors. Now, you would have heard recently lots and lots of talk about South Africa and its bonds and the credit rating, and we will talk about that in a little bit. But most corporate and municipal bonds are rated by one or more rating agencies. Rating agencies analyze the issuing organization and the specific issues to determine the probability of default, and they inform the market of this analysis through their ratings. So basically, look at the creditworthiness, the collateral, all the other issues that affect an issuer's ability to pay the interest and the capital on their bonds. And on the basis of that and the health of the company, they will rate the company. Now, currently there are three major rating agencies. There's Fitch Investor Services, there's Moody's, and Standard & Poor's. In bond credit analysis, the primary question is, will the firm be able to service its debt in a timely manner over the life of the issue? Now, recently, Moody's decided not to downgrade South Africa because they credit rate sovereign issues as well as corporate issues, and we were lucky enough to survive, and we have not been downgraded by Moody's to junk status. We are still investment grade. Unfortunately, Standard & Poor's in 2017 downgraded South African bonds to junk status. Now here we have the credit ratings for Moody's and Standard & Poor's, and looking at the different categories. The first four categories are investment grade, which suggests a low probability of default, and beyond that they are speculative and junk. The ratings assigned to bonds have an impact on their marketability and liquidity, and the interest rate that is charged, so the cost of the bond, is affected. So the lower the rating, the higher the interest rate, or the higher the yield that investors require because of the risk. Now, when looking at the bond ratings, an investment grade rating for a bond is crucial because it may restrict the category of institutional investor that can actually invest in their bonds. Institutional investors such as insurance companies, banks, and pension funds can only invest in investment grade bonds. So if you look at the fact that Moody's didn't downgrade us, it actually means that we are still a viable investment for large institutional investors. So a junk bond or a high yield bond is a bond that is not considered investment quality. The kind of investors who invest in these bonds have a higher than average risk tolerance. Reasons for being in the junk bond category: you have fallen angel bonds, companies that once had high credit rankings but now face hard times, emerging growth companies, they are not yet established small firms, or companies undergoing restructuring. Could be as a result of a leveraged buyout or fending off unfriendly takeover offers. For countries, political instability, poor economic outlook, and uncertainty, future uncertainty, all could lead to a sovereign bond being rated as junk bonds. And that unfortunately is what happened to us with Moody's last year here in South Africa.